But it is funny that we've been together for 4 years and never really know each other, but just recognize.
Good afternoon. I'd like to welcome our guests to the Federal Reserve today as we consider an important milestone in the board's effort to mitigate the potential risks that systemically important financial companies could pose to financial stability in our economy. The proposed rule that the board is considering today would impose a risk-based capital surcharge upon the most systemically important U.S. bank holding companies. This framework would provide incentives to these banking organizations to hold substantially increased levels of high-quality capital as a percentage of their risk-weighted assets. This, in turn, would encourage such firms to reduce their systemic footprint and lessen the threat that their failure could pose to overall financial stability. The proposed rule is an important part of the board's efforts to establish enhanced prudential standards for the most systemic U.S. banking firms and would improve the resiliency of these firms. I look forward to today's discussion of these important issues, and let me now turn to Governor Tarullo.
Thank you, Madam Chair. The proposal before us today lies at the intersection of two important principles of post-crisis regulatory reform. One is that strong capital requirements are central to ensuring a safe and sound financial system. The other is the relatively new principle that the stringency of prudential standards should be proportional to the systemic importance of regulated firms. The proposed system of graduated capital surcharges would be another step toward implementation of Section 165 of the Dodd-Frank Act. It builds on the framework for capital surcharges agreed upon in the Basel Committee on Banking Supervision for application to banks of global systemic importance. The Federal Reserve, along with a few like-minded central banks, was an early advocate for the capital surcharges, and we should be pleased that we were eventually able to reach international agreement on this important innovation in international capital standards. The proposed regulation differs from the international framework in two significant respects. The calibration of surcharges would generally be higher than those applicable to the 8 covered U.S. banks under the international standard, and the formula by which we calculate applicable surcharges would directly take into account the reliance of each firm on short-term wholesale funding. Let me briefly note the reasons for both these differences. First, with respect to calibration, surcharge levels for most of these 8 banks would be higher under the proposal than those required by the Basel standard, and likely meaningfully higher for some of the firms. The approach to calibration we developed in cooperation with other Basel Committee members was to determine the additional capital necessary to equalize the probable systemic impact from the failure of a systemically important bank as compared to the probable systemic impact from the failure of a large but not systemically important bank holding company. However, the surcharge levels ultimately agreed to by the Basel Committee were toward the low end of the range suggested by this analysis. The levels included in the proposed rule are more in the middle of that range and, as suggested in an economic impact analysis undertaken by Basel Committee members, should provide substantial net economic benefits by reducing the risks of destabilizing failures of very large banking organizations. The applicable surcharge would be increased as a bank's systemic importance grows and reduced as a bank reduces its size, interconnectedness, reliance on short-term funding, or other characteristics that determine its systemic significance. Moreover, the surcharges apply only to systemically important banking organizations. Thus, other banks may have capacity to act as substitute providers of credit in response to any reduction in at least some forms of lending by larger banks. Finally, I note that several other countries have also decided to enhance financial stability by applying capital standards above Basel surcharge levels for their systemically important banks. With respect to the difference in the proposal's formula from the Basel formula, inclusion of a short-term wholesale funding factor reflects the fact that reliance on short-term wholesale funding can leave a firm vulnerable to creditor runs that force the firm to rapidly liquidate its own positions or call in short-term loans to clients. Both of these responses can lead to fire sales that create a vicious cycle of mark-to-market losses, margin calls, forced deleveraging, and further losses. Thus, reliance on short-term wholesale funding is among the more important determinants of the potential impact of the distress or failure of a systemically important financial firm on the broader financial system. Unfortunately, the surcharge formula developed by the Basel Committee does not directly take into account reliance on short-term wholesale funding. Inclusion of reliance on short-term wholesale funding as one of the 5 factors in the systemic significance formula is intended principally as a means for assuring the resilience of large firms that are in fact dependent on such funding. It is not a substitute for liquidity regulations such as the liquidity coverage ratio or the net stable funding ratio that we will be considering next year. In conclusion, the proposed rule would strengthen the Basel standard as applied in the United States, both by raising the surcharges to levels that would yield greater net economic benefits and by explicitly incorporating a factor for determining those surcharges that lay at the heart of the recent financial crisis. The proposed Federal Register notice includes a number of questions designed to elicit views on these and other features of this important regulatory advance, and I look forward to seeing public comments in the coming months. Let me now turn to Mike Gibson for a full presentation of the proposed rulemaking.
Thank you, Governor Cerullo. The proposal before you today would complement other measures the Federal Reserve has taken to strengthen the resiliency of U.S. GSIBs and to reduce the risks that these firms pose to U.S. financial stability. To put today's proposal in a broader context, I would like to mention 3 such measures: the LISIC, the stress test, and resolution plans. First, in response to the lessons learned from the financial crisis, the Federal Reserve has changed the way we organize our supervision of the largest, most systemically important banking organizations. We created a Federal Reserve system-wide committee called the Large Institution Supervision Coordinating Committee, or LISIC, that oversees the supervision of these firms. The LISIC is founded on several principles: that large institution supervision should be more centralized, that it should focus on regular horizontal examinations across the entire group of firms, and that it should be multidisciplinary. As a multidisciplinary committee, the LISIC includes senior Federal Reserve staff from supervision at the board and at the reserve banks, from research, legal, markets, and payments. Second, our stress testing, which is part of our annual Comprehensive Capital Analysis and Review, or CCAR, is a valuable tool for ensuring the resiliency of the largest U.S. banking firms during periods of financial or economic stress. The CCAR exercise applies to the largest banking organizations and recognizes the greater risk that these firms pose to financial stability in times of stress. The most recent stress tests conducted earlier this year were the 4th round led by the Federal Reserve since 2009, and the results demonstrated that the largest banking organizations in the United States are collectively much better positioned to continue to lend and to meet their financial commitments in a severe economic downturn than they were 5 years ago. Third, while these measures and the proposed GSIB surcharge framework aim to improve the resiliency of GSIBs, it is also critical to improve the resolvability of these firms in the event of their failure. We have been working with the FDIC to evaluate the resolution plans that are required by Section 165 of the Dodd-Frank Act. We and the FDIC have jointly given feedback earlier this year to the largest firms on the shortcomings in their resolution plans and the changes that are needed to make these firms more resolvable. The board staff have also been working with the FDIC to develop a proposal that would require U.S. GSIBs to maintain a minimum amount of long-term debt at the parent holding company level. Together with the proposed GSIB surcharge framework that is being considered today, these efforts should better ensure that U.S. GSIBs maintain a strong capital base that guards against adverse economic consequences that could contribute to systemic distress and reduces the likelihood of economic disruptions caused by problems at these firms. With that, I turn to Ann McKeon and Jordan Bleicher, who will provide a more detailed explanation of the rulemaking before us today.
Thank you, Mike. I will discuss key provisions of the proposed rule that would implement a methodology for determining whether a large U.S. bank holding company would be identified as a GSIB and for computing a risk-based capital surcharge for each identified GSIB. My colleague Jordan Bleicher will discuss the calibration and implementation timeline of the proposed surcharge. Then we, as well as my colleagues, will help answer any questions you may have. As Governor Tarullo described, the proposed rule is based on an assessment methodology and surcharge framework developed by the Basel Committee on Banking Supervision, but is modified to address systemic risk concerns specific to large U.S. bank holding companies. The proposal would require U.S. top-tier bank holding companies with $50 billion or more in total consolidated assets to calculate a measure of their systemic importance on an annual basis and would identify a subset of those firms as GSIBs based on that measure. Using year-end 2013 data, 8 U.S. bank holding companies would currently qualify as GSIBs and be subject to a capital surcharge as a result. Specifically, the proposal would use 5 broad categories correlated with systemic importance: size, interconnectedness, cross-border activity, substitutability, and complexity to calculate a numerical score for each large bank holding company. The data needed to calculate a firm's score is already publicly reported. If a bank holding company's systemic footprint score is above a certain threshold, it would be identified as a GSIB. The threshold is intended to capture bank holding companies whose failure or material financial distress would pose the greatest threat to financial stability. A bank holding company that is identified as a GSIB would then determine its GSIB surcharge under 2 methods and would be subject to the higher of the 2 resulting surcharges. Method 1 would use the 5 categories correlated with systemic importance that I just noted and is aligned with the Basel Committee's surcharge framework. Method 2 would also use these categories, but would replace substitutability with a measure of a GSIB's short-term wholesale funding. Method 2 would also generally produce higher surcharges than Method 1. My colleague Jordan will discuss calibration in more detail in a moment. The measure of a GSIB's short-term wholesale funding under Method 2 would consider the firm's daily use of short-term wholesale funding averaged over a calendar year. Short-term wholesale funding generally would be defined to include liabilities with a remaining maturity of less than 1 year and would focus on those liabilities that give rise to the greatest risk of creditor runs and associated systemic externalities. In line with this, our definition of short-term wholesale funding would not include retail or operational deposits. Under the proposal, each component of short-term wholesale funding would be weighted. In general, the proposed weights would progressively decrease as the remaining maturity of a funding source increases and as the quality of the collateral securing a funding source increases. The GSIB surcharge would be integrated into the board's regulatory capital rule by increasing the size of GSIB's capital conservation buffer. Under the board's regulatory capital framework, all banking organizations must maintain a minimum of 4.5% of risk-weighted assets in Common Equity Tier 1 capital and hold an additional 2.5% to avoid restrictions on capital distributions and discretionary bonus payments. I will now turn to Jordan, who will describe in more detail how the proposed surcharge calibrations would differ under the 2 methods and how the higher surcharge may impact U.S. GSIBs based on board staff estimates.
Under the proposal, GSIB would be subject to the greater GSIB surcharge resulting from the 2 methods described by Anne. Based upon the proposed formulation of the 2 methods, a GSIB would be subject to the surcharge resulting from Method 2 in most instances. Under the proposal, the 8 GSIBs would be subject to estimated surcharges ranging from 1.0 to 4.5%. On average, the estimated U.S. surcharges are approximately 1.8 times the Basel Committee surcharges. While the Method 2 surcharge generally would be the binding surcharge, a GSIB could potentially be bound by the Method 1 surcharge. Staff believes the Method 1 surcharge, which is based on the BCBS global framework, should serve as a floor for a GSIB surcharge. This approach would facilitate comparability among jurisdictions implementing the Basel Committee's surcharge framework. As Governor Tarullo indicated, the proposed surcharge calibration is based on board staff's analysis of the capital necessary to equalize the probable systemic impact from the failure of a GSIB with that from the failure of a large but not systemically important bank holding company. The proposal also builds on analysis conducted by the Basel Committee and its members of the long-term economic impact of stronger capital and liquidity requirements for global banks. The study found that tightening risk-based capital requirements for global banks would provide substantial net economic benefits by reducing the probability of a financial crisis. Indeed, the study found that such benefits would continue to accrue at even higher levels of risk-based capital than are reflected in the Basel III standards. The calibration of the proposed surcharges is intended to maximize its net economic benefits. Since 2009, the aggregate Tier 1 common equity ratio of the 8 firms currently identified as U.S. GSIBs under the proposal has more than doubled. This substantial improvement in firm capital positions reflects, in significant part, the board's revised regulatory framework and stress testing regime. As a result, staff estimates that almost all of the 8 GSIBs already have sufficient Tier 1 common equity capital to meet their estimated GSIB surcharge on a fully phased-in basis, and that all firms are on their way to meeting their surcharges over the 3-year phase-in period, given both continued phase-in of the capital deductions and phase-in of the buffer. The proposed GSIB surcharge would help ensure that firms maintain strong capital positions as we move further away from the financial crisis. Now turning to timing. The proposal would phase in the GSIB surcharge on a straight-line basis from January 1, 2016 through January 1, 2019. This implementation period was chosen to align with the phase-in of the regulatory capital framework's capital conservation buffer. That concludes our formal remarks. With that, my colleagues and I are happy to address your questions.
Thank you very much. Let me start off, and I want to first thank the staff and Governor Tarullo and the Banking Supervision Committee for all of your excellent work on this proposal. I think the first question I wanted to ask pertains to the likely impact of these surcharges on the decisions of the affected GSIBs to rely on short-term wholesale funding. And I guess my question is, do you see the surcharges as actually creating any incentive for a GSIB to rely instead on more stable forms of funding? And I guess I'm asking this question in part because, as I understand it, the SIFI surcharge, while it takes the dependence of a GSIB on short-term wholesale funding into account in computing its magnitude, in fact, a firm's capital charge would only really change if the funding pattern that it engages in changes enough to move it from one surcharge bucket into another. But at the margin, for a smaller change, it doesn't strike me that it creates such an incentive to shift funding patterns. And I understand, I guess, that the purpose of this surcharge is to reduce the odds of failure of a firm that is systemic. But it seems to me there's also merit in trying to force internalization by market participants of fire sale externalities that are associated with reliance on this kind of financing. So that's my question.
So you're right that the inclusion of short-term wholesale funding in the systemic importance measure would give an incentive to a bank to reduce its reliance on short-term wholesale funding or to shift to longer maturities or higher quality collateral to reduce its systemic footprint measure, which would tend to reduce its surcharge. Now, the proposal does include buckets of 50 basis points, so you have to reduce your systemic impact measure enough to get into the next lower bucket. The decision to propose buckets, basically it's a trade-off between how predictable will the surcharge be and how strong is the incentive. So having buckets gives it some predictability because there will be fluctuations from year to year and banks need to plan in advance. So it should be relatively easy to plan. If you're in the middle of a bucket, you'll know that it will take a big change to move you to the next bucket. But, you know, there is still some incentive, especially when you get lower in the bucket, to reduce your systemic impact sufficiently to get into the next lowest bucket. So that was a trade-off, but certainly we're asking for comment from the public on whether we got the trade-off right. And obviously you could make smaller buckets, or there's different ways to go about it.
I would add that this particular element of our SIPI capital surcharge framework is just one of the different ways that we're attempting to force these firms to internalize the externalities of their usage of short-term wholesale funding. So we'll have this surcharge on the capital side. We also have adopted the LCR, and we've been working internationally on the NSFR and margin requirements on securities financing transactions. So there are other elements of our current regulatory regime and other future coming elements of the regulatory regime that will, as a package, produce the right structure that we want.
Thank you. Let me just ask one other question, and it concerns the stress test. Isn't it necessary in order to make sure that many of these firms, I guess, already have capital levels that are in excess of what would be required under this proposal? In order to meaningfully increase capital levels, isn't it necessary for these firms to also change the threshold that has to be passed in the stress tests?
So the question about whether the GSIB surcharge should be incorporated into the post-stress minimum for the purpose of the stress test is something that is not addressed in this rulemaking. This is a rulemaking for relative to the regulatory capital rules. We have a separate rule, the capital plan rule, that governs the stress test. But we did note in the proposal and would welcome public comment on the question of whether some or all of the surcharge should be incorporated into the post-stress minimum. And the reason is that if you believe that the motivations for the surcharge around systemic risk impact are the same in times of stress as they are in normal times, then that would be a reason to include it the way you suggest. But that's not something that's being proposed here. That's something that we plan to come back and talk about in the future.
Okay, thank you very much. Vice Chair Fisher.
Thank you, Madam Chair. The two methods for calculating the surcharge, basically the second replaces the reliance, replaces substitutability by the reliance on short-term wholesale funding. Presumably this discussion must have taken place in Basel as well, when it was decided by Basel to do it the other way. What were the arguments one way or the other?
So we definitely had a lot of discussion at the Basel Committee around the composition of the Basel formula. Say one thing that's different is that those discussions happened several years ago when we were still evaluating what our regulatory program, we in the US were still evaluating our program around short-term wholesale funding. So we had identified it as one of the risks coming out of the financial crisis, but we weren't able to convince people in Basel to retain it as part of the actual formula. But when we came back, and in the few years since Basel crystallized its formula, we've been focusing more on that and are really have focused on ways to address the risks from short-term wholesale funding, which is why you see the difference here. Now, there is a review underway in Basel that will be coming in a couple of years on their formula, and we have certainly taken the position with them and shared our analysis with them around the reasons why it's a good idea to include short-term wholesale funding in the measure of systemic importance. And we hope that they take that on board when they review their measure, as they've already committed to do.
Has any other country adopted the approach we've taken? They're all free to do this.
So different countries have done different sorts of surcharges. I'm not sure what other countries have gone ahead and adopted the Basel formula yet.
So most of the Basel Committee members who are home country supervisors for GSIBs have adopted the Basel GSIB framework. Japan is the only other jurisdiction that hasn't adopted it yet. So most of them have adopted the Basel framework. A few have chosen to put their own super equivalents on it. Switzerland has done something. Sweden and the Netherlands have also done things. They're different from what's being proposed here, and they don't incorporate short-term wholesale funding, but different jurisdictions, based on their local conditions, have been adding their own bells and whistles on top of the basic Basel framework.
Just one other question. If you compare the Method 1 surcharge with the Method 2 surcharge, 2 looks really a lot stronger. And so I was kind of surprised when I got to the point that it said, well, that you said, well, actually, there's no bank that is going to have to increase its current capital. Did I get that right? No.
Roughly. You want to repeat what the... I think what we said was that almost all the banks with their current capital today would meet the fully phased-in surcharges that are being proposed. So almost. We said almost all.
Yeah, you have one bank. Well, having said that, you also had one bank that didn't.
Right.
It seemed to be quite a powerful impact. It's a big bank, and it was 22 billion short. That seemed pretty impressive shortfall, which seems to mean that I know that Governor Tarullo and you, the banking supervisors and regulators, have been very concerned about short-term wholesale funding, and there are other places where it enters as well, doesn't it, in the calculation? So there was something in the capital structure of J.P. Morgan, which is a firm which is going to actually have to come up with more capital, which made it different than the others. What was that? And why doesn't it meet the requirements already?
So the Basel Committee has published its list, which shows the different buckets that the U.S. GSIBs are in, and that's publicly available. And we've been collecting the data for them on the components that go into the Basel Committee's systemic importance measure, which is Method 1. We're proposing a Method 2, which includes short-term wholesale funding as 20% weight of systemic importance, but we haven't been collecting on a regulatory report the measure of short-term wholesale funding in exactly the way the way that's being proposed in the regulation. And since the regulation's out for comment, we expect to get comment on the ways that we've defined the different buckets. It's a two-dimensional matrix of weights on different types of short-term wholesale funding, depending on maturity and underlying collateral type. So we know what the Basel Committee surcharge formula produces. We have estimates of what the Method 2 surcharge would produce. And we can't be as precise about the Method 2 surcharge as we can about the Method 1 surcharge because it's based on confidential supervisory information that's only estimated. So I think we're pretty confident that with our projection that almost all of the companies would meet would have enough capital today to meet the proposed surcharge. But we didn't go into more precision about that because of the fact that the Method 2 short-term wholesale funding measure is something that's just being proposed now for the first time, and we don't have good data on that measure.
Okay. Thanks very much. This is not only important, it's also interesting. Thank you.
Governor Tarullo.
Thank you, Madam Chair, and thank you, Mr. Vice Chair. Just to clarify a little bit of what the issue that the Vice Chair was asking about. I think, Mike, isn't it my perception on the question of the factors for the systemic formula is that even over the last couple of years, internationally, in both the Basel Committee and the FSB, there actually has been more attention paid to the short-term wholesale funding. Mm-hmm. You know, 3 and 4 years ago when we were talking about this in Basel, some of the countries, I think, were already of the view that short-term wholesale funding created big vulnerabilities, but others were much more focused, I think, on size and some of these substitutability issues. In the intervening years, as you see in the net stable funding ratio and with the minimum margining requirement, there's been a good deal more concern, I think. So some hope, although to qualify it, that over time we might get a change in the international formula, which would more accurately reflect what we think is the systemic risk associated with some of these institutions. One question, and I think the Vice Chair's question may have clarified this, Jordan, but I just want to make sure it is clear to everybody. On the question of the firms likely being able already to meet the surcharges that are proposed under your method 2. As Mike said, the data is not precise enough to let you make a real judgment about that. But when you said that, you were not referring only to the Basel Committee formula, right? You were also referring to the method 2, which includes the higher surcharges?
Yeah, that's right.
Okay, I just want to make sure people are aware of that, because in the stress test every year, we have been incorporating the anticipated Basel surcharges, but not these. Okay, good. Second question I had was on the issue of the rest of the world and the fact that many countries at least haven't yet chosen to apply surcharges higher than the Basel framework, which is really a set of minimum surcharges. I referred in my remarks to the fact that the Basel economic impact analysis suggested that there was more gain to be had from greater resiliency, staving off financial instability, and that on net it was still a gain for the economy. But what about the issues of direct competitiveness between U.S. banks that would, under this proposal, have higher than Basel surcharges, and banks from other countries, not, I guess, Sweden or the Netherlands or Switzerland, but from other countries, which might have a very similar risk profile, systemic risk profile, but would, at least as of the moment, have probably a somewhat lower surcharge. What kind of competitive effects are you projecting on the U.S. banks? And I guess just a little discussion of that would be helpful.
Sure. So we tried to design the framework, the structure of it, and its calibration primarily to achieve the financial stability goals that we had, but we did give some consideration to competitive effects. I think the principal competitive effect that we anticipate is a leveling of the competitive playing field between the most systemic U.S. banking firms and the less systemic U.S. banking firms, the small, medium, and large but not quite systemic class. So we think those competitive advantages are pretty significant. We also think the whole international framework of surcharges for GSIBs, foreign and domestic, is one that will work to the competitive advantage of the small, medium, and large but not systemic U.S. banking firms. But to your specific question about the competitive playing field between the U.S. GSIBs and the foreign GSIBs, as you noted, there are a few countries that are going to go super equivalent like us, and others may follow. We expect others will follow, but probably not all. So from our perspective, equity capital is slightly more expensive than debt capital. But at the same time, well-capitalized banking firms tend to have a lower cost of debt financing as well, so there's something of a natural offset there. I think there are also times in the economic cycle, particularly in the stressful economic times, where strong capital can be a competitive strength. And I think as we've watched our large American banking firms compete with foreign large banking firms over the past few decades, they've been subject to higher capital requirements all along the way, and they've competed reasonably well against their foreign competitors. To the extent that certain of the U.S. GSIBs find our proposals, if finalized in their current form, to be a competitive impediment, they'll always have the option to reduce their systemic footprint under our formula and therefore reduce that competitive disadvantage. But fundamentally, we're mostly focused on trying to achieve our financial stability goals at the least cost to economic growth and credit availability and credit costs, and that was our primary motivation behind the proposal.
Sorry, just one other question. Mike, when does the Basel Committee have scheduled a reconsideration of the formula for determining systemic importance?
Yeah, and I'm looking at Wayne because I'm not sure of the timetable for that.
So the timetable, the Basel Committee has a 3-year review of the process, and that process has just started. So it will be roughly 2 to 3 years before proposals are really in hand. There's going to be a period of data collection on possible measures, assuming that the initial data collection is approved by the Basel Committee.
Thank you, Madam Chair.
Thank you, Governor Powell.
Thank you, Madam Chair. So the vulnerabilities of short-term wholesale funding were
critical to the evolution of the crisis and the damage that was done. And we've responded appropriately with a broad array of measures, including, as Governor Trujillo mentioned, LCR and the NSFR, but also tri-party repo reform and money market reform. Today's measure, soon enough, minimum margins on securities financing transactions. So, and yet we know that there is still a role for short-term wholesale funding. I mean, it is appropriate if used safely. And so I wanted to give you a chance to discuss whether we've left enough room and how we think about that, and how we feel about the possibility of affecting important financing markets like, for example, Treasury repo.
Okay. Might take a shot at that. The basic reason, I think, for including short-term wholesale funding in the surcharge formula has been said, is that we think that the surcharge should scale based on a firm's systemic footprint, and we think that short-term wholesale funding is a key factor in determining the impact that a firm's failure would have. As you say, inclusion of the short-term wholesale funding component in the surcharge is part of a broader package of reforms that also includes LCR, NSFR, and potentially other things like margin requirements. With respect to the sort of impact of including short-term wholesale funding on things like the Treasury market and other markets, we think there are several factors that reduce the risk of adverse impact. One is the weighting system that the surcharge would use to assign weights to different types of short-term wholesale funding liabilities. To the extent that short-term wholesale funding liabilities are backed by U.S. Treasuries or other highly liquid collateral, those liabilities would receive a relatively low weight. To the extent that short-term wholesale funding liabilities are backed by less liquid collateral, they would receive a higher weight. That differentiation, I think, would help to protect against some of the potential adverse impacts that you suggested. It's also important to note that short-term wholesale funding is just one of 5 factors in the surcharge formula. So although the proposed surcharge levels are roughly double those of the Basel standard, short-term wholesale funding is only going to be about 20% of the total. So that should also reduce the impacts that the inclusion of that component could have. And then finally, I'd point out, it's probably relatively clear already, that the surcharge would only apply to a handful of firms that are systemically important. So to the extent that those firms decide to reduce their activity in certain areas, other firms not subject to the surcharge could potentially substitute.
That's very helpful, Jordan. Thanks, Matt.
Thank you, Governor Brainerd.
Thank you, Madam Chair. So the way this proposal is designed, you're trying to calibrate the surcharge, I think appropriately, to get institutions to take into account the specific kinds of risks that they're posing to the system in terms of things like interconnectedness and reliance on short-term wholesale funding. And it's nicely tiered. It really presents an important advancement on the tiering of regulation. How did you, though, trade off the desire to carefully target those sources of potential risk to the system against the desire, which I know we also have, to maintain a fairly simple, not excessively complex system of requirements for financial institutions?
So I guess the way the surcharge, the systemic impact measure is designed, it does trade off the complexity versus the effectiveness, and the decision was made to go with a relatively small number of indicators. I think there's 12 indicators that we collect data on already under the Method 1 surcharge, and then there will be the additional short-term wholesale funding data under the Method 2 surcharge. And it's a relatively small number of data points for each firm, and it is publicly available in the case of the Method 1 surcharges, or it would be in the future publicly available under the Method 2 surcharge. So it's possible for either the banks or the public to calculate their own surcharge and to do what-if scenarios to say, well, if we reduce our size or our interconnectedness by so much, how much would it change our systemic impact measure and what effect would it have on our surcharge? So it is a trade-off between the simplicity of the system and giving the right incentives. But we've tried to strike a balance, and we certainly welcome the comments on whether the balance is appropriate or not.
Second question about the design is, as in the international framework, there's kind of a first level, you're in or you're out, at a certain level of complexity and size, and then a sort of calibration above that. What's the thinking about institutions that may be large and complex but don't quite hit that threshold, and what kinds of additional incentives might you think about building in the future there, or is this going to remain a sort of pretty high threshold above which there's a surcharge and below which there's not?
So you always have to draw a line, and some banks are going to be in and some banks are going to be out. I think in the U.S. we're relatively fortunate that there's a big gap between the least systemically important GSIB among the 8 that are included in the current proposal and the next bank on the list that would be systemically important. So there's no issue around if the line were a little bit higher or lower, a U.S. bank would be in or out. Now, that's not true in other countries, and that is more of an issue for other countries. One way the Basel Committee manages that is that countries are allowed to add banks to the GSIB list, so they might have one bank that's right above the boundary and one bank that's right below the boundary that they see as very comparable, and so they might put that second bank in through supervisory judgment, even if their score was a little bit on the low side. But we don't face that. We're lucky that we don't face that issue in the U.S.
So we do have enhanced prudential capital standards for bank holding companies greater than $50 billion. So we do have something targeted to those firms, and then the purpose of the GSIB surcharge is different. It's really focusing on systemic risk above and beyond the adequate capitalization and the enhanced supervisory and regulatory focus we put on all of the large bank holding companies.
Thank you, Madam Chair.
Yes, of course, Vice Chair.
A simple question relating to what Governor Tarullo has, Governor Brainerd has said. What is the minimum definition of globally active or internationally active? Is that some X% of its revenue business or something?
So the Basel Committee collects data from the 75 largest banks in the world to do their systemic impact score, and then they compute the scores and they rank them, and they have a methodology that has a cutoff, which currently includes 30 global banks, is that right? 30. So 30 out of 75 are judged to be in the systemically important group. And the line was drawn originally just based on the judgment of looking at, where the measures came out.
So there's no number. If you do X% of your business abroad, you're...
Well, it's a complicated formula with many variables, and they're all weighted, so it's not quite as simple as that.
Further questions? Okay, hearing none, what I'd like to next do is have a go-around, and I'd like to ask each person to state their position on this proposal, whether you support it or not. Maybe we'll start with Vice Chair Fisher.
I support the proposal, Madam Chair.
Thank you. Governor Tarullo?
And I do as well, but it is a proposal, and as always, I think we'll all be interested in hearing the comments upon it.
Governor Powell?
Thank you, Madam Chair. I, too, support the proposal. I think it makes sense to include short-term wholesale funding since it was such a crucial vulnerability in the crisis. I think that these higher levels of risk-based capital will both reduce the probability of default and also, in some sense, encourage firms to reduce their systemic footprint. As always, I look forward to hearing and reading, understanding the comments and considering them, but I'm happy to support the proposal.
Thank you. Governor Brainerd?
Yeah, I believe the proposal represents a significant step in tiering regulation to reflect the risks that an institution poses to the system. I think it's important to note that the enhanced capital requirements will be material only for institutions well above the $50 billion Dodd-Frank floor, with a focus on those institutions that are complex and highly interconnected. I think it also builds on the new capital framework in a clear and direct way. It very much embodies the one, I think, resounding lesson from the crisis, which is that excess risk-taking and distress at the largest and most interconnected firms pose risks not only to the safety and soundness of those institutions, but also to the system. And so our new surcharge builds in incentives for senior managers and the board to take into account the risks that they're posing to the system overall. I think it is important that the proposal requires greater capital. The greater is the institution's reliance on short-term wholesale funding, which does reflect the lessons we learned on asset fire sales when we see distress in these institutions. And I think it's also important, as was stated earlier, that the calibration is on specific metrics that institutions themselves can take into account. And because the the capital surcharge is in direct proportion to this set of metrics, it provides clear benefits to actions that a firm might take to reduce its size and its complexity, which I think are all desirable features. So I support the proposal, and I'm interested in seeing the comments that we receive on it. Thank you.
Thank you. And I also support approval of this notice of proposed rulemaking, and I'm also looking forward to seeing the comments. I certainly agree that financial institutions whose failure could result in systemic consequences for the broader financial system and for the economy as a whole should hold more high-quality capital than organizations that have a less systemic footprint. And I think this does impose meaningful additional capital requirements. I'm pleased to see that the staff has gone beyond what was required by the Basel proposal, and I think that that's appropriate. With respect to the decision that you've made to include reliance on short-term wholesale financing in deciding on the systemic footprint, I think that definitely makes sense because the failure of a firm with high reliance on this kind of financing, I think, would impose greater costs on the financial system in the economy. But I would simply add that in terms of forcing firms to internalize the externalities, the fire sale externalities associated with their decisions to rely on short-term wholesale funding, I don't think that this proposal completely addresses these risks. And you mentioned the LCR and the net stable funding ratio, and I hope staff will continue to consider a set of minimum margin requirements that would address this issue and would do so broadly throughout the financial sector and not only for these firms. Okay. So we're going to have two separate motions. I first need a motion to approve the proposed rulemaking that would establish a risk-based capital surcharge for U.S.-based global systemically important bank holding companies.
So moved, Madam Chair.
Thank you. Second?
Second.
All in favor?
Aye.
Aye. And now I need a second motion to authorize staff to make minor technical changes to prepare the proposal for publication in the Federal Register.
So moved.
Thank you. All in favor?
Aye.
Aye. Well, thank you. Both motions pass, and we'll look forward to the comments and appreciate all your hard work. Thank you.